Nigeria. A member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynG.org for more details. CFA Society Nigeria, making finance a force for good.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Thank you very much, and welcome back to the second half of today's session. As I invite Biola Ahmed for equity investments, I'd like to use the opportunity to say a big thank you to our sponsors, First Quartile and New Frontiers Learning. New Frontiers is in Lagos, First Quartile is in Abuja. Also to say a big thank you to our facilitators so far and the executive office for the support. Biola, over to you.
All right, thank you so much, Yemi. Please confirm you can hear me.
Loud and clear, and we can see your screen.
All right, thank you so much. Welcome back from the break. I hope we are all revitalized for the next section. So I'll be taking equity. My name is Abiola Ahmed. I work in investment banking. All right. I have a note here. So what I intend doing this afternoon is take us an hour through my notes, then we'll go through problem solving for the next an hour. So I might be, please, if there's anything, can stop me at any point so we can just have some discussion. Okay. So we'll take the first. So we have 8 topics in it. So the first is market organization and structure. So basically, the first is all the function of the financial system itself, right? The first one highlighted here is moving money through time and leveraging our quantitative method, time value of money, really, because what you are trying to do is to actually have a compensatory model for 2 parts of the market, the savers and the borrowers, right? So if I want to consume more than what my income is right now, I could actually discount my future earnings or my future income to consume right now, right? And if I want to postpone or defer my consumption, I could move my money through time using the financial system in terms of saving and borrowing. Also, the financial system also help in determining the market price, right? Market price for money really is the interest rate, which is the cost of borrowing, right? And also the interest you earn on your savings. Also, the system helps in that capital allocation, in terms of where you get the largest return for your savings and also which business to fund. So if a business, in a sense, destroys value, the financial system makes it possible for that system not to thrive or not to have repeat access to funding in the market. So that's basic for three function of the financial system. So looking at the classification of the assets and the market, you have the financial assets, the real assets. So financial assets basically talked about securities, the contract in terms of derivatives, and also currencies, right? If you look at the real asset side, these are the tangibles, real estate, the commodities from oil to wheat to corn to precious metals, and also we have even art collections. Even now, we have digital assets that is even coming on stage and even more getting so much traction in the market. When we talk about the market, we can have the primary market where the issuer actually comes to the market at the first instance. So transaction in the primary market essentially is between the issuer and the investors. So the investor actually have a direct contact with the issuer in the primary market. But anything on the other side where the issuer actually is remote to transaction happening, basically happens in the secondary market. So from your exchanges to the over the counter. So here it is investor A and investor B transacting. So right, and that's what happens in the secondary market. So let's just move on. Come in, let me just see this. I'm not too used to Zoom anyway, but okay. Right. So we're looking at participants in the market, right? Intermediaries. So we have two pockets of people. On one side, we have the issuers, right, and the other side we have the investors. But to bridge the gap between these two classes of market participants, we have the intermediaries, right? That actually talk to issuer, liaise with the investors, and make that bridge and or connect these two pocket of individuals. So we have the broker dealers exchanges, right? Where those securities are listed. We have the securitizers, right? These actually are the ones that engage in financial structuring and say, can we have mortgage-backed securities? We have a pool of real assets, right? And layer on top of that in the pool, we can on the back of that, on the issue securities that investors can actually invest in. You have asset-backed securities, depository institution, our deposit money banks, right? Insurance companies, just to have some kind of safety. We have arbitrages. So these arbitrage guys really look at mispricing, right? Mispricing from one market to the other, and also trade off on that. Clearinghouses, custodians, right? Position leverage. So, right. So we have hedging. In this market, you could do hedging, right? So hedging basically is you say if you're let's say a corn farmer or you run a refinery, right? You sure know you need crude oil to run the refinery. So what you do, I don't want to expose myself to the volatilities in this market day to day, right? Happens in the airline industries. I need to buy fuel for my jet engines. I don't want to be exposed to daily pricing volatility. So can I basically have some contract to actually have some fixed price over, say, next 3 months. I'm a farmer. I'm in the planting season. 3 months, my cons will be out. I don't want to start facing the market for pricing at that point. Can I have some contract that lock in some prices at this point? So that's what we do in the agent side. You have leverage position, right? So back to our financial statements, right? Return on equity is basically our return on assets multiplied by financial leverage, right? So in this space where you could take a position with some initial margin, which is your equity contribution, and take on a larger scale in terms of layering on that another portion of debt just to magnify your returns. Couple of other execution, market order, it takes the best price in the market, either a buy or a sell, a bid, right? Then we have limit order, whereby you say, I want to make this purchase, right? I can buy at, let's say, trading at let's say $2 price. So I say I'm willing to buy as much quantity or unit in as much that the price doesn't go past $2.50, right? So my limit is $2.50 for the buy. So my order keep executing up to $2.50. At that point, it stops executing. So that's the limit buy. Also, I could do a sell also and say I keep selling till $2.50. So the price at 3, keep fulfilling those orders at $2.50 stops. So those are execution that are much options for investors. So we have validity also. So I place an order, 1 million shares of a particular firm, good till the end of the day. So depending on the number that was filled in the day, once the market closed, the other units or unfulfilled orders are cancelled, really. So we have the other one, which is probably like a good to cancelled. Basically, once I have order that not yet fulfilled in a single day, in a single trading day, the next day it picks up from there. So I'm trying to rush through this. So we're taking security market indices, right? So basically, here we are looking at the market the market as a whole or broadly now, and looking at return calculations. So we could do a price index. So price index basically look at capital gains, price movement. So this trade at $3 today, and the next day is trading at 30. So that price movement is what it's considering alone, exclusively price. So we could do the return index, right, which takes layer on top of that. So if a particular security has paid, when we look at an index that has 10 securities or 10 stocks, right, 5 of them paid dividend during the investment horizon we are calculating the return for. So those income that dropped or the investors have received over the time is incorporated in the return calculation for a return index. So it takes care of both price and dividend. Also, we look at index weighting methods. So we have index that weight based on prices. So exclusively just on prices, and that's what the index weight is based off on. So if I have so let's say a particular index comprises of 3 securities, one is traded at 30, 20, 10, total price in there is 60, right? Then I could do, you have 3 securities. Let me just get some of these. So I have a that is at, so the index has 3 securities, right? This is at 30, this is 20, and this is 10. So for a price index, it takes a sum of the 3, which gets us to 60. How many securities in there? That is 3. So the index point at the beginning is 20 points. So let's say after a single trading day, this price have moved to 33, this is gone to 15, and this has gone to 20, right? We have a total of this 68. Divided by 3 again, will come to, so 22.67. So I can then calculate what's return the index has generated. 22.67 over 20, 2 minus 1, So I could say the index has returned 13.3%, right? That's for a price weighted. However, we could do another that's basically equal weighted. So for equal weighted, every constituent of the securities contribute equally. So what we do for equal weighted is basically you calculate your return based off on each of these. So from 30 to 33, that's 10%. 20 to 15, that's negative. Negative 25. 10 to 20, that's basically 100. So let's sum this up. 10, negative 15, this gets us to 85, right, divided by 3. So it assumes equal contribution from each of the constituents, right? So we'll get to something around 28.3% for the entire index. And you can quickly see the difference in what is happening. So if I'm doing an equal a price weight, this is the return I'm getting, I'll calculate for the index. However, I'm doing an equal weight, I'm doing something different here. So we could do market capitalization, and there are some indices for price. We have the Dow Jones, right? For market cap, most indices are based on market cap, right? Even the Nigeria index, right? So basically, this looks at the outstanding share outstanding. It computes the share outstanding, basically taking the market cap of each of the securities, right? And based off on that, we then look at the market cap for the next day and look at what movements the entire index has made. Yeah. Just to have some more reflection of what the investor. Now, when we look at the investor, look at the general public as made in the market. We have this float adjusted. Right? We have some companies that a substantial portion of those shares are studied do not trade. They are probably held in some family office or held in the hand of some probably the founder of the business. So we could do a float adjustment for the shares outstanding, right? Before we then calculate the market cap of such businesses. So why do we use indexes? So one, to reflect market sentiment. So if we're following Nigerian Stock Exchange, there have been a lot of movement over a couple of days or probably months now. So investors, so we can make statements as investors are bullish, investors are bearish, so something like that. Then also performance benchmark, right? Quite a number of portfolio managers have mandates to track indexes. So if I have a mandate to track the NSE 30, so basically my performance at the end of the year will be benchmarked against what has the NSE 30 or the all share index has done through the year. Also measures market return. So where we say Nigerian market is the best performing in probably last year, 49%. So it is, we could do all those statements, could make those statements because we are tracking what this index had done from the start of the year to the current time. We probably have the horizon. So we have type of index. We have index that tracks sectors like the NSE 30 biggest. So we have something like the S&P 500, right? 50 most capitalized firms in 500, right? Then for the S&P 500, we have the broad market index or share index for Nigeria. We have the sector index. We have the banking sector, but exclusively tracks the banking stocks, bank stocks. We have energy sector, probably tracks upstream, downstream, probably some utility firms. So we could have index that actually this specialized. Okay. Let's move on. Any question yet? So I'm good to move on. We're looking at market efficiency. Okay, I think I'm tracking the charts or something. Okay, none. Thank you. All right, market efficiencies. So if we look, I need to clear this board. Please, somebody help me. Is there a way to track, clear this once? Okay. All right. For market efficiency, basically, informationally efficient market talks about how quickly and how fully the market reflects, let's say securities reflect the total information out there about a particular firm. So I'm tracking a particular company. So does the market price that is, or what the share is trading for, does it reflect total of information available, publicly available information, right? Does current price of a security fully and quickly? Also, we then look at how quickly the price adjustment happens. So we are all expecting particular earnings per share of, let's say, 2, then the company has just reported $1.50. How quickly do the price adjust downward to reflect this new information? So those are the track or metrics that reflect how informationally efficient a particular capital market is. Right? In a perfect efficient market, passive strategy. So because we are saying we don't have so much friction in this market. Security prices do not have so much friction. Yeah. So if we have a market that has that kind of perfect efficiency, a particular investor that is chasing or that embarks on passive strategy, basically just buying a mutual fund or buying the index, will outperform an active strategy, because an active strategy will incorporate, so you are engaging a portfolio manager to trade on your behalf, right? Chasing alpha. So it will come with, because you have a lot of turnover in that portfolio, we have commission on trades, exit and entry, right? We have withholding tax that crystallize when you actually take some capital gains, right? Also, you then pay the portfolio manager a management fee. So layering on top of the returns, all these fees actually drag the return downwards. That's why a perfectly efficient market will experience a passive strategy that outperforms an active strategy. So also, just studying on that, the return on any security basically is to compensate for the risk regarding the future cash flows. So, and one of the very, very key component of in computing our valuation is this, especially for stocks, equity, we have this cost of equity, right? The assumption really is that the cost of equity that goes into the denominator of discounting the future cash flows. So we have the future cash flow that's been discounted 1 plus KE into future, right? This KE should reflect all the risks that investors, according to the investor perspective, right? And so we see some stocks being discounted at 12%, some at 20%. The difference between this is investors are considering this security, let security B, much more risk, and to compensate for that risk, they are discounting at this very elevated interest rate, elevated cost of equity, right? So, so when we say the return on equity, actually basically is compensating the investor for the risk they've assumed in purchasing that security. So, an alpha strategy, basically, active management is trying to explore market inefficiencies, hoping to generate excess risk adjusted return, because that's basically what qualifies you, or what justifies the added fees and that you are charging the client. Measuring market efficiency. So we look at basic method to do this. So when we look at the market, I've discussed this alpha, that's SS risk adjusted returns, right? After compensating for the risk, we talked about the 20%. So if a particular manager can actually get to 25, that 5% extra is the alpha. right? And when we look at the market value versus intrinsic value, so market value basically is the current price of a particular stock. Then when we look at the intrinsic value, is you taking it back to your own model and say, based on my discounted cash flow model, based on my pricing comparables, on my home model, my judgment, I believe the price of this stock should probably land at this price. And that is basically your own intrinsic value. It's judgment, right? It's your own judgment. And you see a lot of disparities. In fact, that's where trade happens, because somebody believes the particular stock is overvalued at some point. I want to sell at that point. And as another person, rational investor, believes it is undervalued. It is because of disparity in the judgment or belief about the performance of a stock that trade itself happens. So we have fairly valued, basically your market value is equal to the intrinsic value. We could take undervalue. When we say a stock is undervalued, basically the market value is below the investors or the analyst judgment around the intrinsic value. And when the opposite is the case, we say the stock is overvalued. Right. What are the factors that affect market efficiency? These are very time. Okay, we have number of participants in the market. So considering let's say a New York Stock Exchange compared to a Nigerian Stock Exchange. So we have a lot more analysts in that place. We have a lot more portfolio manager. The market is deeper in that kind of market. Also, another very important is the composition of the investors. And we see that happen in Nigerian Stock Exchange, right? So when we have lot of local investors, they tend to be more patient compared to a foreign investor, FPI, that comes in and add the little information they are out and they're out. So we know, so a lot of that is changing in Nigerian Stock Exchange, right? So we have a lot of more domestic investors, which gives that it depends volatility, right? In number of in and out that investors do for a foreign investor compared to what a domestic investor would do. Availability of information, how accessible are this information? So you can access the financials on SEC website, access on some dedicated website also. So the amount of information available to investors also determines market efficiency. Impediment of trading, frictions, taxes, some regulations also against short selling and all the rest. So because you basically for short selling, you probably make a bet against a particular stock. So if that particular type of trade is not available in the market, so you can't express your judgment as a trader on both sides. So if I expect a particular stock to perform, I can buy. If I expect it to underperform, I should be able to sell. If I can't take my position based on that, so it can lead to there is either I buy or not buy. so limiting that kind of transaction also increases market inefficiency. So form of market efficiency, we have the weak form. Basically, it says the prices we are saying reflect or has incorporated all past prices and volume, right? And if you believe this efficiency, you wouldn't do some particular trade. And that's particularly the most important part of this section in terms of what type of strategy do you embark on based on your judgment on the level of efficiency you are seeing in the market. So if I believe the market is weak form efficient, I would not expect any positive risk-adjusted return in embarking on technical analysis, right? Because I believe that the current stock price I'm saying has incorporated all the volume and as well as prices, that's past prices. So I can't then start making patterns, all the pattern that a technical analyst will probably say this is the support level, this is some resistance. Because I believe that whatever price happens today has incorporated all of this. So I don't expect any outperformance in engaging into kind of trading strategy. Moving on, we have semi-strong form, right? So it layers on top of the weak form and also add all available public information. So if I believe that the market price reflects all of the available public information, I probably will not engage an analyst to give me target price, give me something like stock recommendations based on just analyzing the financial statements, because I expect this is available to every investor in the market, and everybody, if there's any value to be extracted off of that, the investors will have traded on that on the stock exchange, and will have seen the price reflect all of that information. The last form, the strong form, takes layer on the semi-strong and also add private source information, which essentially is this insider trading and insider information, which strongly discouraged. And so if we believe that, hey, I don't expect any excessive positive risk-adjusted return by taking active management, so why engage a portfolio manager? So the work of portfolio manager basically is not really to let's say outperform the market, but also just to balance risks and return, right? And also in managing the client. See, a lot of value add for a PM comes from understand the temperament of the investor, and we take a lot of that when we do behavioral finance. So I understand my clients, and then I can tailor their trade strategy or the kind of investment I put in their portfolio based off on the kind of person or the personnel I've read my client to be. So, and that's the value add for a portfolio manager, not really to chase return or give me alpha at some point. We have some market anomalies that the curriculum also highlighted, and behavioral finance introduction here, and we'll do much of that when we do level 2, and a lot of that in level 3 also. Let's move on. The time is running. Okay, overview of equity securities. So a lot of introduction here in terms of what is available in this space, in the equity space for investors. So we look at common shares, which is very, very popular around stocks. So we are stocks, basically common shareholders. These are the shareholders, they have the residual claim. So in the order of rights, they have the residual claim after settling all the obligations to other investor in the business. So basically we look at your senior secured debts, unsecured debts, coming down, preference shareholders, then the last. So in case of a liquidation, they get at last, right? But because of that, they have voting rights. That's another thing. They can actually drive the way the share or the firm should go. Also, we have the preference shares. So preference shares is a mix. It's a mix of common stock and debt. So it performs kind of a common. So for a preference share, I have like a promised preference dividend. Let's say it's 10%. So my 10% is kind of promised, right? And that's why it exhibits this characteristics of both of a common stock and a debt and debt. So yeah, no voting rights. We have some convertible preference shares. So there are quite a number. We have cumulative, non-cumulative, right? Cumulative will say, I promise you 10%. The company don't make money in year 1. I did not pay this. Yes. But in year 2, when we start making money, I'll pay you your 10% of last year, competitive for this year, before paying the common shareholders. There's some charts for me. Oh, okay. So this new information under CAMA 2020, preference shareholder have voting rights. So we have convertible preference shares. So convertible preference shares holder is basically saying you could convert from being a preference shares holder to the common shareholder after some agreement or terms in the agreement have been fulfilled, right? And give you that right to participate in the upside that we see the common shareholders enjoy, right? So you are capped on the floor in terms of your 10% return, right? But then if you then roll this over into a common shares, you have this unlimited upside that you earn in terms of capital gains that the stock can do. Also, we could do a private equity. Basically, less liquid, just private placements. So you have a company, a firm that is non-public, right? Non-public, run by a single individual. I have a PE firm does this valuation, and say based on this valuation, I can give you $500K, right? And then I own, let's say, 60%, 60% of the business, right? I inject equity into the business, right? And then take a proportional holding in the business, and hopefully, and also give some types of guidance and management contribution in terms of guidance in how to run the business based off my own experience at a private equity firm, right? And expect the business to perform well. Then we have another round of valuation on 5 years. The business has done so well, and then I can exit. So my exit can come in terms of managing this business till IPO, or probably do a secondary sale to another private equity firm. And we've seen a lot of data on the market now. So you roll this over to another equity firm, and you have your 24 or 25x exit, right? So what's incentive private equity offers is that potentially greater return for investors when the firm either goes public or I exit that secondary sale with a better valuation. So I valued the business when I came in at 500K at something around 3. So if my 500K gives me 60% of the business, so I'm probably valuing at 833. So if that business then goes to being valued at 24 million thereabouts, I could see a lot of upside in that side. And so when I'm exiting, I'm coming out at substantial greater returns. Okay. Venture capital, basically, these guys invest in ideas. And when we do alternative investment, we have a lot of categorization in that space too. Invest in ideas. We have a lot of people that just come in and do Series A, do all of this seed capital, basically fund the ideas, come in and say you want to scale up that business. So we have a lot of stages in that venture capital space. Come in the early life cycle of the business. These are just, I believe in this idea, I want to propel this, I want to give you that capital backing to do this very, very ambitious to implement this ambitious idea. We could look at the leverage buyout. Basically, leverage buyout basically says, I go take a lot of debt, go in, buy an existing company that is probably struggling or not struggling, but it's a mature firm. I believe that given my own expertise, I could give better efficiency to the business. The cash flow from the business can pay off the loan. So I need to have a firm that's mature, a firm that I see a lot of inefficiencies in, or I see a firm that has gone to be so big that if I can take over the firm, I can spin off some components and sell off those components, generate a substantial amount of cash to pay back the loan that I've used to buy off this way. So I take a loan from a bank, some investment banks, come in, buy the firm, restructure the business, pay back that loan. But so let's say if the firm practically trades, is publicly listed prior to me buying it off. So I buy off all the publicly listed shares, take the company private. You can see an example with the Twitter deal. So take the company private, then restructure, refinance, probably spin off some of the part component of the business that are not doing so well, generate a lot of cash to pay back the loan. Also, we could have another variant of this, which is management buyout. Basically, it is done by existing management of the business. The CEO, the executive directors feel we don't want to be chasing quarter per quarter disclosures to investors. Can we buy off all the shares at some premium? That is very at some premium. Take the company private. These are that latitude to chase long-term goals, right? So when it's the same model, right? But it is basically the kind of investor that is running the deal. So if it's an external investor, like an Elon Musk, I'll probably say an LBO. But if it's an internal management that is running taking the debt to take the public-private, that is an MBO, management buyout. Okay, we could do this private investment in public equity, right? Quick capital raise. So a public equity listed firm struggling, needs some capital injection. You could go to the market and approach the market and go and do equity, right issues, bonus shares, right issues, and all of that, right? To just get recapitalized. Or you could approach few select investors and do a private placement and basically get the needed capital at which is quicker, right? So I could do that but comes at a compromise. The private person that will give you that money probably, if the shares trading at, let's say, a 10, probably buy those shares at 9 so some kind of compromise on both sides. We do foreign equities, basically taking your direct equity investment into foreign listed shares. I could do the deposit receipts, whereby those shares are bought by could be a sponsored or non-sponsored. So a particular, let's say, a bank buys some foreign shares, hold it in their own, have on the back of that issues securities in the domestic currency. So we have a GDR, Global Deposit Receipt. We have the American Deposit Receipt. Very interesting space. Please, if there's any question, just let me know. Okay, this is not for me. So we'll get to do the risk and return characteristics of equities. So we could do what are the component of returns I see in equity. So look at the price changes, basically your capital gains. Okay, so GDR. Okay, GDR is a global deposit receipt. This everything outside America. So the same model, right? So if a particular sponsor or a particular firm buys off stocks, let's take a contest around Nigeria now. So a particular bank buys off Tesla shares, a million worth, bring them to Nigeria, put it in a custodian, a custodian bank. Based off of that, issue naira shares. They are back with these foreign shares, right? Once that's practically global. But once that is happening in America, that is ADR, that's your American Deposit Receipt. I hope that answers that question. In every other jurisdiction outside America, we can call it GDR. Okay, so the return in the equity space. Okay, thank you. The return in equity space comes from price changes, the capital gains. So I bought this stock at 20, currently it's trading at 50. Price changes. Also, I get dividends, probably quarterly, some semi-annual or end of year. That's another income generated for me in holding that equity. And also, if if I'm holding foreign stocks, the gain and losses from movement in exchange rates also give a sizable amount of returns to investors. And this can swing in both ways, right? Especially this can swing in both ways. Especially if you are an investor based in a strong currency space and you're investing in some weak currency zone. So that 49% you are chasing in some markets, you can probably be facing a negative 90 in foreign currency movement, which wipe out all of this return you've generated in that local market. So it's something that investors need to be very cautious of, think hard on around how to hedge. And that's where we have all of these derivative contracts, just to give that risk management to options to investors. So risks for equity securities, look at the standard deviation of returns. We have some fat tails, right? We have the normal distribution, we have some fat tails when you have a lot, and left tail risk, right? In terms of those sizable down movement in the returns. And well, you could do a lot of management around this in terms of portfolio management, diversification, just not putting all the eggs in a single basket. Another concept very important as we move on will be the market value compared to the book value, right? Book value basically looking at your balance sheet. asset and liability in that space. So what's comparison with these two? Asset minus liability. Market value basically is, and we've seen a lot of stock traders sizable amount of multiplier on their book value. So market value is, investors are forward looking, right? Your balance sheet is a snapshot of the current position of the financials. Investors are forward looking and say, look, this company is a good company. They are good to have, but they have been growing at 10%. They have enormous runway. And based off on that, I'm ready to put some. So if you look at some price multiples, price to book ratio, 20, 10x. So basically, it is investors' judgment around the upside that the business or the amount of value the business can generate in its future operations. And that's what we see in your market value, which is the current price. Another thing I want to touch on briefly, because I think we're going to do a lot of this in the valuation, is cost of equity versus the return on equity. Right? Cost of equity basically is looking at what the investors deem appropriate as the compensation for their risk they are taking in investing in this business. And we have a lot of models that gives insight into how investors think around this cost of equity. So let's look at our single factor model, like the CAPM, right? So I do my risk free layer on this. So because if I'm investing in an equity, in the equity space, I say, what are my alternatives? I could give my money to government and earn risk free. So layer on top of that, the beta, which is the correlation of the stock return to the general market index, right? Then I'll take the equity risk premium. So I'll do risk-free rate plus beta multiplied by the equity risk premium to get this cost of equity that I expect for this particular stock. And the judgment, the judgment will come in this space, the beta. So some stock are coming at 1.2, some 0.9. This reflects, right? Reflects the amount level of correlation with the investors are expecting in the return of this stock to the entire market, how risky the stock is compared to the entire market. So I can have a lot of expression of my risk in the beta that I placed in calculating my cost of equity. And immediately this goes up, I will see that in this cost of equity going up. And we have some, right, some factor model do just use only equity risk premium. I'm going to have an extension of this, the 5-factor model, the former French, and all the rest. So these are models used to calculate the cost of equity. Accounting return of equity, so we have our return on equity, which is our net income over average equity. So just for us to have clarity around, these two are very different. That's why I just highlighted in the note. Okay. Please, if you have any question, you can drop it in the comments. I'll move on. We're moving on to analysis now, past and present. So this is just a build up, and I believe that I think what level 1 does for us is really getting us ready, prepared, or getting us prepared for level 2 and level 3. And in my own thinking, I believe that a lot of questions will build up on this side of the curriculum in terms of, especially the last chapter talking about the equity valuation, because I want you prepared for those very deep analysis we'll do in level 2. So a build up on that, company analysis, what do we do? Company research report, the analysis, valuation, investor recommendations, operation. So on the operation side, we look at the 3-statement model, and it's very important for us to look at that also in our practical skills. There's a very good model around forecasting and building our 3-statement model. So I'll look at the operation of the business. How do I forecast the 5 years into the future in terms of what I see in the income statement, the balance sheet, the cash flows. So I'm looking at something around all of this in the operations of the business. Transaction, also we look at transaction in terms of if there's going to be a deal around an M&A or the rest, and also the valuation. At what price should I buy the business? At what exactly is the business worth today? So when we talk about the business model, basically it's how does the business generate value, right? How does the business make money? So key driver that ultimately affect income statement and balance sheet. So revenue will dovetail down to net income, dovetail to retain earnings, go back to balance sheet on the equity side, and that's how you can generate value for the investor, for the shareholders. So look at the revenue drivers. Look at your. Oh, sorry. Can you hear me? Please confirm. Is it better now? Okay. Apologies. Thank you. Thank you, Esther. So revenue drivers. What drives the revenue that the business is generating? So is it the level of competition you see? Is it a market leader? And we're going to do the next chapter talks more on that side. But there are some formulas I want us to note here, right? which are so we have. Okay, I'm using an headphone actually. Well, is it better? Okay. A lot of people are struggling with my voice now. So it might be network though. So it's fine some area. Okay. I think majority can hear. All right. So some formula that I want us to actually note going forward, which is operating profit. Right. And we can easily get to this also by visualizing our income statement. So we have the top line. We have our top line revenue. Then we have the cost of goods sold. So it gets us to the gross profit. Layer on that all our fixed cost, SG&A, OPEX, get us to EBIT. Take on that the interest, gets to earning before tax. Take tax out, and you get your net income. Right. So this model is basically what we are trying to then have some codified formulas for here. So if we look at the operating profits, which is exactly what we are looking at here, right? Takes the quantity multiplied by price minus variable cost. These are variable cost, right? Then take out the fixed cost, SG&A and the OPEX, operating profit. Then another thing here is the contribution margin per unit. So this, and we are going to do this more when we do the corporate issue as corporate finance in terms of where's our break-even point, right? Price minus variable cost. Degree of operating leverage. So if we look at this part here and compared to this, basically that's our degree of operating leverage. And when we look at the degree of financial leverage, we're looking at this EBT compared to this EBIT. So we're looking at a lot of the comparable amount of value eroded or lot of charge the company face on this interest expense, right? Give us the financial leverage. And because you make money, you don't make money, you have to service those debts. So if I see a lot of value being eroded in this interest expense space, I can start saying what are the value I could prefer to this business. Am I talking about balance sheet restructuring? Am I talking about consolidating your financing option or diversifying? Probably you have to come to the capital market to raise some of this fund instead of looking at commercial loans. So a lot of value add can be extracted from you understanding your degree of operating leverage for your business, degree of financial leverage for your business. So we have some formulas around here: percentage change in operating profit over percentage change in sales. So how sensitive is operating profit to the changes in sale, basically? So if you have a business that is loaded with a lot of fixed cost, right? A lot of fixed cost, your rent is fixed. Your salary, maybe some salary are not fixed anyway, but a certain part of your salary is fixed. So you make money, you don't make money, end of month, you have to pay, you have to do the payroll, you have to pay the rent, right? And that gives you how sensitive those, what comes down to this EBIT, what be retained in the any after any before interest and tax, because of this level of fixed cost that's being loaded in the business right up here. Same with financial leverage, you have to service those debts, and we have to think around those formulas going to the exam. Okay, so moving on, industry, and I want to close this in an hour so we can go to solve questions. Industry and commodities analysis, right? So we'll take this like a funnel. When we want to do our industry analysis of commodity analysis for a business, it's usually like a funnel. So I will just highlight that, and it can really help us in thinking through this on our own. So you look at a typical funnel that goes this way, then comes down this way. All right. So I want to understand the industry first, which I put in here. So I'm coming to the complaint on this, the firm level here, but it gets me a good context, right? And this will be our top-down approach, right? A good context around what industry. So let's take for instance, I'm thinking of a business now. So let's for instance someone that wants to start a school, right? Probably I've not even defined the kind of school I'm trying to start, but I want to understand what exactly is happening in this education sector, right? Look at the supporting policies, look at the market size and all of the rights. So come down, understand what the size of the market is, understand the size of the market is, so that I say, and then you start to get what are the unique characteristics of this industry. So if I'm probably taking a particular, and there are a lot of life cycle analysis here. So I have this S curve, right? So if I want to engage in a business that is in this very early stage, you have the early stage, you have the rapid growth, you have this maturing, then I don't want to go and invest in a business that is facing sunset, right? So a lot of analysis goes into this. One, to rightfully calibrate what profit expectation is, right? Also to give me the kind of strategy I should come to the market with. So if I'm coming to a market that is very deep with, very fragmented, lot of players, I don't even know where the attack is coming from. Compared to where I have just probably the market leader, one other player, and one other player. These are the three people I need to study, compared to where I need to study some 20 other firms. Right. And this is so the kind of approach I come with here. Yeah, a lot of people are engaged in the business. Barrier to entry is very small, or no barrier to entry. Yeah, these guys are very concentrated, right? This market leader, if they see a threat, they can actually snuff life out of it. So the kind of strategy I come in here with the stealth mode, coming in before I announce myself in the market, I get some weight before announcing myself. So all of the analysis goes into the kind of strategy I come into the market with, how I position it in terms of pricing. So it helps in defining the kind of strategy I come in with. Also, in terms of what promise I make to investors in terms of returns, or how confident I am in surviving in that market. So look at the external influences. We do a PES2 analysis, PES2 political, environmental, right, technological analysis in terms of what are the threats, looking from outside in. So we have the portfolio forces, barrier to entry, the power of suppliers, power of threats from how the degree of market competition. All of this is very important in right sizing, in my entry, in also calibrating my approach in establishing this business before then coming to the company level. So on this company level, I then look at the market players, what given the existing market player, what approach am I coming into the market with? So I have cost leadership. Am I going to produce at the least cost? And we'll see a lot of that in. So if a Saudi firm can produce oil at, let's say, cost of oil is $7 over there, they practically can trade profitably at crude oil price at 10 or 12, compared to somewhere in Nigeria where we probably have some cost structure around 27 or 37 per barrel. So if same thing, probably you're looking at telecoms in Nigeria, the per unit force probably is, let's say, 20 naira for an hour call, right? And that will form the top line revenue, right? The expenses and everything. So if you want to come to this EBIT side and say, what I want to attack is how to be so much lean, so lean that I can charge lesser here and retain the same probably operating profit margin. Also differentiation. So I want to differentiate my product so well that I can capture some value in terms of higher pricing, given that I operate so differently. So you can see our funnel model give a view of the industry, give us existing players, give us the threats, and also help us to calibrate the strategy to enter the market. Okay. So forecasting, right? And this is where that particular skill module will help us substantially, because they spend a lot of time in putting together that course. Probably after our exam, we can actually just look at it. It's very, very robust in terms of the kind of content that's available in there. Okay, so what we are doing now is looking at how do I, given probably I have like, so I want to look at the right size to enter or to buy this particular stock. I need to get in. Remember our conversation around the intrinsic value. What intrinsic value compared to the market value? So I can make a judgment around, is it fairly valued, overvalued, undervalued? So to engage in this intrinsic valuation here, I need to look at the financial statement of the business, project into the future, because every investor is forward looking, right? So I have probably I have past record of their income statement, at the balance sheet, at the cash flow statement, right? Now it is then left for me to say, okay, what particular valuation model am I using? Then I want to project into the future, 5 years, 10 years, whatever the case might be, also giving my own investment horizon. So this chapter is actually addressing how do I achieve that projection to the future. That's our forecasting. And we look at each of the income statement item and the balance sheet item. So our typical model building will start from the income statement, right? Do the top line, probably when I get to the interest level, I go do the capital structure on the balance sheet, then come back, then go back and build the cash flow statement last. So first, top line revenue. I can approach this using the top down. What is the macro doing? So if a business is supposed to grow, so I have the existing income. I say I project some 10-year growth annually, but I don't want to just pick that 10% growth from the thin air. I say, what is the GDP growth rate, right? I can probably contextualize that and say 3%. This industry that this company is existing in, what is their probably the mean or the average or the median growth rate? I say it's some 15%. So this particular company that I'm evaluating, do I expect it to outperform the median in the industry or below? So if I say this is one of the most agile firm in the industry, it can grow at 20%. So I can project for the next 5 years at 20%, right? But I can do this from top down level, right? The other one is probably the bottom. I say bottom up. So I'd say a retail business, they have 20 stores. The sales per store is, let's say, 1 million. So they are coming to 20 million in revenue. But if I expect or probably read the management discussion analysis, and they're saying that over the next 5 years, they intend to build or expand their store footprint to, let's say, 25, and so 25 over 5 years. So maybe I can just do 21, 22, 23, while maintain the sales per store. With that, at the point of 25 stores, I should be expecting 25 million revenue. So you could see I'm more granular when I do the bottom up, right, compared to the top down. So then we can then look at the income statement and the balance sheet, the recurring and non-recurring items. So look at your so we have most times also advisable to ideally look at these non-recurring items on a standalone. So something like a share repurchase. This not something I do every time. Something like some disposal of some assets. So the company has said they are going to dispose some asset off in some 2 years time. So expect some income from that if they are able to dispose it off at a profit compared to the carrying cost on the balance sheet, right? And those kind of that will come to their income statement. So I don't just want to normalize that and say they are going to keep disposing assets over the next 5 years. So I'll model those items as a standalone. Cost of goods sold, we understand that 1 minus the gross profit margin, right? SG&A, also we give allowance for inflation on this side. Just we are looking at each of those items. How do we forecast each of those items? Basically, that's what this data is all about. Working capital, right? Usually we do this by looking at, we start from the existing account receivables, inventory and payables, calculate the days of receivables outstanding, like days of sales outstanding, days of inventory on hand, days of payables, right? Using that, you can then infer the level of receivables, inventory, and payables going forward. So very important for us to look at that. So other item, capital investments, look at the, so what is the business saying around capital expenditure for the next, let's say I'm doing forecast for 5 years. So are they saying that they're expanding a factory in 2 years time, which we actually put a body on that in terms of capital expenditure in that 2-year mark. So I incorporate that in my modeling. Capital structure. So they are projecting to build a factory in 2-year time that will cost, let's say, 20 million. Right? Have they disclosed how they're going to finance this project? Is it 40-60? Right? Are they saying that they're going to maintain the existing capital structure? So if the existing capital structure is 30-70, right? 70 debt, right? I can then assume that in projecting the level of debt that they will need to finance this project. Off of that, I can model the interest expense also. So you can see a lot of interconnectedness in all of this. All right. Then, very important scenario. So we don't just have a point estimate for these values, especially when we come to the final, what is the value of the business. So we want to do something like a worst case, a best case scenario, right? And the base case, just for the model to be more robust. So more robust is very important to do. And also then, the model is as good as the assumption that has gone into it, right? So we are tweaking this assumption. So scenario is basically changing multiple assumptions at the same time and looking at the combined effect on some metrics, let's say on our profit margins, on our return equity, on our valuation of the business. So we are changing so many moving parts at the same time just to get an insight into what could be the impact of these combined variables. So we look at economic environment. Are we expecting a downturn? Are we expecting some kind of recession in some 2-year mark? Are we expecting more competition to come into the market that can depress their revenue, take away their market share? Technical changes, is the ground shifting under them? So all of this will help us in building up this our worst case, best case, and best case scenario. But it's very important for us to look at that practical skill module. This whole thing is all, the 3-step modeling is all explained in there for us to take advantage of that. So this is the last topic, equity valuation, concept and basic tools, right? I presume this is just in preparation for for level 2. So let's spend some time here and just solve questions on this side also, because what I found out that this topic or chapter combine. So you can use the institute like this a lot if you can use a single question to test multiple concepts. So I can have a question that tests from different between preference shares and common shares to what the cost of equity is, to what the capital structure is. So let's look at it. So consideration for investing based on value differential. So we talked about MV versus IV, right? In the opening. And now if I come to an intrinsic value of a business that differs considerably from the market value, before I go execute on that and make investment decision based off, so the price of this share is 200, and then what my intrinsic value says is it is ought to be 250. This says it is undervalued. I should go and buy, right? Before executing that buy order in the market, there are some things I need to actually understand or consider. First, the difference between the market value and the investment value is immaterial, right? Because at every point I execute a sale or a buy, I have commissions that will come in. If it is a sell, I have tax implication, I have commission on exit, all of that. So the profit I'm trying to actually, or the value I'm trying to capture, does the fee justify those values? So also we have to look at the confidence devaluation model. Like we said earlier, the model is as good as the assumptions that have gone into it. So how confident am I in terms of my assumptions in arriving at my intrinsic value? Also, look at the depth of researcher following the stock, right? I don't operate in silos. Look at what are other analysts saying about this stock. What is the target price from other trusted hands in this market? And also, given we want to also look at the level of interest in that particular stock. So if you have coverage by 200 people, 200 analysts compared to a stock that we have coverage for probably 5 analysts following that. So you can expect that there could be a lot more inefficiencies right here, and that you can actually capture compared to what. So if there's a consensus around 200 people, well, wisdom of the crowd, you could probably think if your own valuation comes to 190 here, or something very substantially different from what 200 other professionals are arriving at, you might want to go back and check your model, right? So also we want to look at, am I seeing any market event that will trigger a convergence? So you say getting the valuation right in a wrong time is as good as getting it wrong. So if you believe that let's cast our mind back to the tech bubble of, let's say, 99 2000, right? So if you've seen that early around 96 and say Amazon is overvalued or some Apple is overvalued, and you've short the market, but everybody think this is the best thing after sliced bread. Everybody keep buying. You are going to be getting margin calls every day. So you want to also understand that how long do I want to intend? So if I have an investor that says I'm placing money with you for a year, right? I've done my own computation and intrinsic value. I believe that a particular stock is undervalued. But over the next 1 year, I don't see any market event that can trigger or awaken the investor community to realize that this thing is overvalued and it should start selling, right? So if I don't see any of this market event within the 1 year which is my investor horizon, I can as well not just invest in this, because my judgment practically will not come to fruition, or no market event to trigger a reawakening among the investor community to then have a convergence in pricing. So if I expect the price at 250, truly this market that is currently at 200 can remain at 200 for the next 2 years. If there is nothing that triggers the market to say, look, this stock is undervalued, and let everybody keep buying to come out so that the market price should go to 250. So you want to be also say, am I going to see a convergence between the market value and the intrinsic value? And also, is that convergence going to happen within my time horizon? So the next thing we look at is what are the valuation models that we are going to look at the discounted cash flow, and this will leverage so much on our QM knowledge, right? Time value of money. We have to get those things right. Then the multiplier models, particularly multiples, yeah. And also we look at the asset based, basically valuing asset on their balance sheet. Okay. So this kind of cash flow model speaks to that our long time value of money on a timeline. So draw our timeline very well. I have 5 years, cash flow 1, 2, 3, 4, 5. I take this series of cash flows, 2, cash flow 3, cash flow 4. I move them through time to this particular point through discounting at the appropriate discount rate. Very important. And the value I arrive here should be the intrinsic value based on my model, right? And I can make a judgment: is it overvalued, fairly valued, or undervalued based on that discounted cash flows. So what cash flow should I discount for an equity? Okay, we should move very after this. We are moving to practice question, right? So we look at the appropriate cost of equity. So we can have the 1 year holding period, which discounts dividend payments and the price at the end of the 1 year. Take those cash flows into 1 year period, and we can have multi-period, right? So let's try and get some speed. So we do cash flows can come in terms of dividend on the stock and also as well as the exit price. The other cash flow for business that don't pay dividend currently is the free cash flow to equity, right? And you can take this out of your cash flow statement. The formula is right here. Take your CFO, take the capex unit investment that need to be done, take into net, and also the net borrowing, which is your debt principal repayment and the net debt issuances that you project for the business. So by cost of equity, we talk about the appropriate discount rate, which is the return on equity. Use the one factor model. For public company, you can take the equity premium plus bond yield, right? You can take the equity premium on the government bond yield. So if you have comparable businesses that have their bond trading in the market, let's say the yield is 12%. So I can then, based off on that, say what is the premium I'm applying on this business. Let's say it's 4%, then my cost of equity will arrive at 16%. A lot of judgment in this space also. And remember our beta, if it's a private company, adjust that beta for capital structure. You know, the levered beta and the unlevered beta. So we do, I think this is a corporate issue as well. You unlever the beta first, then you relever the beta based on the capital structure of the business of your target company. Very important for us to do all of that before arriving at the beta. Preferred stock, value preferred stock, basically very simple. Take the dividend, promise dividend, preferred dividend over cost of preferred stock too. The Gordon growth model, right? So we look at this Gordon growth model, basically take the next period dividend divided by the cost of equity minus the growth rate. Very important. There are some assumptions in here. Hello? I'm correctly shouting here. Can somebody hear me? Some people can't hear, some people can't hear. All right.
We can hear you.
All right, thank you. I guess it's network or something. Okay. So what's are the assumption that makes applying Gordon growth the right thing for us to do? So these models actually have the application, right, in terms of in which business is it that is good for us to use Gordon growth. So I look at company that's mature, right? Probably have history of paying dividends, because basically what we are discounting anyway. They are not operating in a cyclical business. Look at people that are not operating in the discretionary sector, right? Your consumer staples. These are the business that you can apply this Gordon growth to, right? Okay, so also there is one I want us to look at, which is estimating the portion of value due to growth. So what we do in this place is use your Gordon growth that has growth incorporated in it, which is so value the business twice, basically. Next period dividend, cost of equity minus growth rate. You get a particular value here, right? Do the same dividend discounting. Now, don't net out growth in this space. Yeah, you get a value B, so that you can say the portion due to growth. Hopefully, we'll see a question based on this. Is the value A minus value B, and you can quickly see what portion due to growth is in this kind of business. Okay, let's move on. Growth rate in dividends, very important. So we are then zooming in on how to calculate this G. So how do I calculate the G that we are seeing here? So we have some basic formulas around this too, in terms of what is the historical growth rate of dividend. We can use that. We can use the industry median. We can use this formula. This formula is also very important because you probably see it. 1 minus payout ratio. This is payout ratio. So the company has a payout ratio of 10%, right? We do 1 minus 0.1 multiplied by the return on equity. Return on equity historically probably is 10%. You can clearly get to your growth. You can get your G through this place. Or if the same thing as using the retention rate multiplied by the return on equity, right? Also, there are extension of this Gordon growth that look at multi-stage. So if I am expecting a firm to grow at 10%, that usually might not be the long-term stable growth rate, right? Because you can't keep going at 10% forever. So what the multi-stage model assumes is that the company grow rapidly, and also this is leveraging on the life cycle model, right? So grows rapidly, tapers off, then have a stable long-term growth rate. So let's say at this point it's growing at 10%, then we have the growth, and probably this thing will not, the growth probably plateaus at 10, then start coming down, then have tapers off at, let's say, 3%. So there's a model that the first one probably says 2-stage. I have 10%, then I have 3% flat. But there's other model that incorporates transition phase. I have 10%, I have 5%, then I have 3%, which is more realistic than this sudden drop, right? So basically, but all of this, once we have our hands on time value of money, very strong on time value of money, we won't have any challenges in doing this. So multiples, price to earnings, right? Anytime we have the word justified says is basically saying that our pricing was determined using a model, right? Either a Gordon Growth model, discount cash flow model. That's how we determine our price. When we have the word trailing or leading, basically trailing means the current period earnings, leading means the future earnings, E1 compared to EU. Dividend discount displacement of earnings, right? If a particular company is chasing paying out a dividend, the compromise they have to make is to the compromise on their growth rate. So you can't have a large dividend payout year on year and also tell us that you're having a very large growth, because you are not retaining a lot of value in the business, right? So you either have large dividend or you have large growth. So you have a lot of companies that say we don't pay dividend, but you can see a lot of growth in their business because they're actually plowing those money back into R&D, into product development, right? Enterprise value. These are just some highlighted things I highlight to note. So asset-based valuation methods, there are some companies that you can use this very well with financial institutions. The assets they hold are usually very liquid. Your T-bills, government securities, and all of the rest, they're very liquid. Also, your natural resources firm, oil companies, the asset basically is those reserve of oil they hope to explore over the next 10 years, right? And those commodities have values that are globally acceptable. I can have your own adjustment on those prices, and also you can use that to quickly determine the level of asset they hold. So equity value basically is your fair value of asset minus the fair value of the market value of their liabilities. So how do you determine the fair value of the asset? You can add the depreciation values, historical cost minus the accumulated depreciation. You can have inflation adjusted. Especially if you are operating in a high inflation environment, I don't know. So that asset you bought at $1 million today probably is worth something like 2.5. So you don't go and value the business based on this historical asset value. You could adjust for inflation and use this just to have a fair value of the business itself. Another model you can use to do the asset is the replacement value, right? Which is how much it will cost you to buy the same asset today. Another thing we have to look at is advantages and disadvantages of each of the valuation model. So let's take a lot of probably take some time to know all these advantages, so that when you get to the exam and some theory question comes on that side, you can get to it. Okay, so that's my notes. Let's take the next 30 minutes to look at some questions. Do you have any question before we move on? So let me change my screen. Okay. I think I'll just focus on the last, which is our equity valuation. So let's solve questions in that space. So how many questions do we have here? So we can pick at random. Okay, quite a lot of questions, 36. Okay, let's see how fast we go. So question 1, an analyst estimates the intrinsic value of a stock to be a range of 17 to 21. Current market price is 24. Remember our comparison is market value to the intrinsic value, right? In this case, it will be, I think some people also already answered that. Can you maintain the same voice one? Okay. All right. Hope you can hear me better now. So we have intrinsic value compared to market price. So if my intrinsic value is lower than the market price, the stock is undervalued, right? My intrinsic value is lower than the market price, the stock is overvalued. Market price is 24. What I believe the price is to be is 21 maximum. If the stock is trading at 24, that means it is overvalued. I will not buy. It's not a bargain for me to buy. Okay, so we'll just keep some questions. Go to the next one. Present value model. Which of these will I use? Present value model. Present value model is still the same thing as our discount cash flow models, right? We are taking the present value of future cash flows. So I won't use this enterprise value. These are the price multiples. Price to free cash flow is also a price multiple. Free cash flow to equity. Okay, fine. Thank you. C, yes. Free cash flow. So we are using free cash flow to equity for businesses that don't have dividend payment. You want to probably a business that either is not paying dividend or is paying dividend that is substantially lower than the amount of dividend they can pay. So we are valuing the business based off on their capacity to pay, not on the actual payment of cash to the investors. Okay, 5. Book value is least likely to be considered when using book value. When won't I use book value? You can just drop your answer in the chat so we can also think throughout this together. It's least likely. when I'm using present value, because present value, I need cash flow that I'm to discount, right? Multiplier models can use book value, price to book value ratio is what can give me an insight into, is this a value stock or a growth stock, right? It is something that can give me into, is it a good time to enter, right? I will need book value for my asset-based valuation, right? It is asset minus liability. Okay. Question 6. An analyst is attempting to calculate the intrinsic value of a company, right? Gather the following data: EBITDA, total market value of cash, and the analyst least likely to look what. So here you are comparing what variables is available to the analyst, and based on that, which of this model can they use to value the company. So he has, the person has EBITDA, total market value of cash, short-term securities, liabilities. Okay, I'm seeing discounted cash flow model, right? Because if you look at this, I have EBITDA, total market value of cash, short-term investments, least likely. So exactly, I don't see a cash flow here. I could use my multiplier. I can be valuing the asset and liability in this space. Okay, fine. Let's move to some actual calculation. 11. A Canadian insurance company has an issue of 4.8%, 25 par value, perpetual, non-convertible, non-callable, right? Share outstanding, the required return on similar issues is 4.49%. This is our discount rate. Okay, the intrinsic value of the preference shares. Preference shares is the easiest to value, right? Basically, it is our promised dividend payment, which will be the 4.8% of the par value, right? Divided by the discount rate. So do 4.8% of 25 divided by 0.0449. Can somebody help us with that? If you have your answer, you can put it in the chat. It can't be A. How are you getting A? It's going to be B. 4.8% of $25. 4.8% of $25 give us a cash flow of 1.2. That's the preference. That's the dividend exactly. 1.2. Then take that 1.2 divided by 4.49%. Thank you. Let's do some actual calculation again. Question 13. Corporation has paid dividend, just paid dividend of 1.75. If the required rate of return is 12.3%, dividend are expected to grow indefinitely at the constant growth rate of 9.2. Right? Intrinsic value of the stock is what? So let's try that. Very important. Remember, your Gordon growth takes next year dividend, not the current dividend. Next year dividend divided by cost of equity minus growth rate. So let's compute that. Answers, please. So first mark up the current dividend by the growth rate, then divide by the cost of equity minus growth rate. So 1.75 times 1.092, right? So that will give me my next year dividend divided by the cost of capital, rate of return, 0.123 minus 0.092. So I'll get something. So put in your answer, please. Let me put the note on how to do this here, so we can all follow. So first, this is the formula. Next year dividend, I'm seeing a lot of answers. Next year dividend minus divided by cost of equity and growth rate. So first thing we have to do is next year dividend. The current year dividend is 1.75. Mark it up by the growth rate, 1.092. It's growing by 9.2%. So the next year dividend will be something around 1.75 times 1.092. Get me 1.99, 1.911, right? Then divided by the cost of equity is 0.123. Subtract 0.092. And this will quickly get you to 61.65. So it's very important for you to know that this cordon growth uses next year dividends. Okay, let's do 14. Computation is very important for this. You want to purchase a common stock of $2, annual dividend is able to grow at 4%. If the required return is 7%, same thing as 13, right? Take your next year dividend first, divide by the cost of equity minus the growth rate. Okay, I won't spend more time on that again. Let's move on to some. Yes, let's do dividend discount model. Analysts gather information about the stock, current share price, annual dividend for the year. Now, this is where we need our very strong hand on the time value of money. So it's very important for us to do question 17. For this kind of question, I will strongly advise us to first draw our timeline. So question 17. Take this. This I want to get to time 0. They said the growth for the year 1 to 4. 1, 2, 3, 4. The growth rate is 9%. Right? Then after that, subsequently, the company will go at 5%. First thing, what's the dividend right now? Dividend right now is 1.6. So the next thing I want to do is calculate dividend from each of these spots, growing at 9% each year. After that, then find the dividend at this point, growing at 4%. Then it is the dividend you get at this point, you then apply the Gordon growth model to, so that you can value the business at year 4. After valuing the business at year 4, then discount all these series of cash flows to, to 0.1. Basically, that's what we are doing, right? So you do dividend in year 5 using 4%. Cost of equity is 12.12. The growth rate is 0.04, right? You get a value for the business at this point. So timeline is very important here. So we don't want to miss the timeline. Get all the series of cash flows, then also determine the price at year 4, which will be based off on the dividend in year 5. Can somebody do that for us? Or if we are clear about it, we can quickly move forward, because it is based off on that we then judge if it is undervalued or overvalued. Okay, so move on. I've not seen any answer for this question 17. Based on this, can somebody calculate the intrinsic value? Just finding the space in this. So for year 1, the current dividend is 1.6. Okay, somebody got 30.77. If you can have consensus around this value, I won't need to solve any question. I won't need to solve it again. Can somebody else try it? So don't give a damn dollar, please. Before you judge undervalued or overvalued, what is the intrinsic value you got? Okay, let us do it. Is 0, it is 1.6. Multiply each stage by 1.092, which is the growth rate. The growth rate is 9. Oh, growth rate is 9% though. Sorry, 1.09. So the dividend for the year one will be 1.6 times 1.09. So that will be 1.744. For year two, again, mark it up by 9%. So every year, so 1.744 again, going to be iterative, right? 1.744 multiplied by 1.09 again, we'll get 1.9. For year three, we'll mark that again, 1.9 times 1.09, we'll get 2.07. For year four, we'll then do same thing, 1.09, 2.26. For year five, note, year five is growth at 4%. So 2.26 multiplied by 1.04, that is 2.35, right? That is the dividend Y that I referenced here. So what we then do is this 2.35 divided by 0. So it will be 2.35 divided by 0.08. Yes, 2.35 divided by 0.08. That gets us to 29. Fine. And that 29 will be the price or the value of the stock in year four. 29.37. Great. Now discount all of these cash flows. So you have like 4 points, this one, this, and also don't forget the timing and this. So we are doing something around 1.744 divided by 1. Now, for discounting each of those specific cash flows, use only the discount rate at this point. 1 plus, that will be 1.09 raised to power 1. The second one will be 1.9 divided by 1.09 raised to power 2, such that we get present values of all of these cash flows. Okay, that's the final answer after discarding all of the cash flows, right? 24.7. Okay, fine. So we got 24.7 in our valuation. Compare the current price of 22.56. So the stock is undervalued, right? It is priced at 22.56. When we did our own valuation, our model, it ought to trade at 24.7. Great. So very important. This is a game of time value. If you can draw your time value very well, put the cash flow in the right places, it is just plug and play in your calculator. Question 18. The whole thing is so okay, so let's move on. Let me try and clean this thing up. Okay, 18 says Dominion Company, the company just paid dividend are expected to grow at 20% next year, 15% in the year after that. For the third year onward, growth is at 5.6% indefinitely. Again, these questions, just draw your timeline. There are no gimmicks to this thing. To draw your timeline, label the appropriate growth rate, define the cash flows, then start discounting. You usually will start from the last one. So let's try this again. We'll label our timeline very well. So we have all of this times 0, times 1, 2, 3 to in fact to the so for year one growth is 20%. Just put your 20% here. Year two growth is 15. Year three onward is 5.6. So what we'll do, the current dividend is 0.58. 0.58. So we can grow this by 20% to get the value here. Grow this by 15% to get the value here, right? Then grow this by 5.6% to get the value right here, right? Then the value we get at Z we apply the Gordon growth on, which is going to be the cost of capital, which is 0.083. The growth rate, indefinite growth rate is 0.056. The outcome of this computation will form the cash flow C. So we have 3 cash flows. 1, 2, 3. That will move back in time to time 0 to get the value of the business. Please let's try that. What's the value? What's the answer to question 18? Quickly, our time is fast spent. Who's trying that? Question 18, question 18. Is anybody trying this? .5. So we have the first cash flow at 0.696 times 1.15, 0.8. Value Z is times 1.056, 0.845. So let's plug this here. Great, 26. Great, thank you, Damlola. 26. Any other contrary answer? We assume, okay, yeah, 26. So good. Let's move on. Okay, all these questions are practically the same model. You can see a lot of questions will come from that model in terms of multiple stages of growth. The answer to get the way to get the answer is the same thing. Do your timeline, plug in the growth rate, get the cash flows, get the final price using Gordon growth, discount all of this to the present time. Okay, question 20. The best model to use when valuing young dividend paying company that is just entering the growth phase is most likely what? A young company. Okay, someone said 3 stage. Okay, so expecting it to grow rapidly, slow down, then mature, right? Makes sense. Grow rapidly the first phase at maybe 20%, then taper off at, let's say, 10, then at the mature phase, grow indefinitely at 5%. Okay. Let's move on. Let's keep question 21. And also, we don't want to get scared by long questions. Once you have a long question, let's just tease out the most important thing here. So an equity analyst has been asked to estimate the intrinsic value of a common stock of Omega Corporation, a leading manufacturer. It's a mature industry. Both earnings and dividend are expected to grow at 3% annually, right? Which of the following is most likely to be the best? 21, great. A, it's a mature company, Gordon growth indefinitely at 3%. Great. Let's move on. Price earning multiple. Great. Price earning multiple, how do we do that? Expected earnings per share, 5.7. Dividend per share, 2.7. Dividend expected to grow at 2.7% indefinitely. Required rate of return is 8.35. First, let us find what's supposed to be the price of this stock using the Gordon growth. So it's the price that we get using the Gordon growth, right? That we then compare to this earnings per share. So we are using the justified thing, which is the price, PO, divided by the earnings per share, expected earnings per share. 8.5. Great. 8.5. Let's move on. Okay, let's look at this. Using the pair comparison. Analysts has prepared table. We have all of this. As of the date of valuation 2018, the trailing 12 months PE, PCF, PS are respectively 90 days, right? But in the model and on the table is this company overvalued, fair valued, or undervalued? So historically, this company, the price to earnings is 9.2 in 2018, 8.0, 2.5. Very close to what it is done in the 2017, right? P is remain unchanged. Price to cash flow from 7.9 to 8.0. Price to sales has moved from 2.3x to 2.5. So what's our judgment? Fair valued, overvalued, undervalued? C, fair valued, because it has not moved as much to what historical average. Another thing we could do is to look at the historical average, right? Because 2017 might actually be a very exceptional year for the business too, right? So a lot of judgment will go into that question 26. All right, let's move on. Okay. Can we just judge this? This is peer comparison. Similar companies in the banking sector: First Bank, Prime Bank, Pioneer Bank. Price to book ratio 1.1, 0.6, 0.6. Price to earnings 8.4, 11.1, 8.3. Which of the company is undervalued? So if you can put a small line on your thinking, I'm seeing C, Pioneer Trust. Price to book is 0.6. Price to earnings, right, 8.3. That's correct, right? Price to book, you can see 0.6x here, and price to earnings. So a multiple of its earnings is trading the lowest, and also the same thing goes for the price to book ratio here. So we might be seeing a lot of momentum around this Pioneer Bank that is trading at 11, which is very far from the peer. Everybody's at that's 8, low 8 range. This is coming at 11.1, right? But you could see what can then justify that is look at the price to book ratio. Also says that they have quite a number of assets on their books. So a lot of judgment in that side also. Value of the equity rainbow is closest to equity for rainbow company. Yes. So we have the forecast. We want to use the EV to EBITDA. Enterprise value to EBITDA. We have this as 10.2x. We have the EBITDA value. Now, calculate the enterprise value. Enterprise value comprises of 3 things: market value of equity, market value of debt, and the cash in the business, right? So if I know, I know that the EV to EBITDA is 10.2, right? I know the EBITDA value here. I know this. So I can infer enterprise value as EBITDA multiplied by 10.2. Great. So once you get the EV, and we know that EV is market value of so value of equity, market value of equity, right, minus market value of debt plus cash. plus market value of debt minus cash, right? So this is what I want to tease out. Market value of debt is already here, 56 million. The cash in the business, negative. Cash in the business is 1.5. And I know that all of this should, then equity is X here. 10.2 multiplied by 2022 should give me something around 2020, right? 220 million. So I can do 220 million minus 56 plus 1.5. Give me something that which will be the market value of equity. Who solved that already? I'm seeing C, right? You should not be up to C. Into 2 times 10.2, 224. Then subtract your market value of debts, 56 plus 1.5, 169. Great. 169. Please. Everything lies in this formula. EV is market value of equity because the enterprise value to both share equity holders and the debt holders. Market value of equity plus market value of debt minus cash. The thinking is that you can use cash to extinguish part of the debt, which gives you the enterprise value of the business, right? Just have to change the subject of the formula to get your market value of equity. Okay. I'm seeing where can we move to? Where can we move to? Okay, question 33. These are theory, very low hanging fruits for us, right? Take which one again? Question EV. Okay, let's take it again. Let me just clear this. Okay. We have the price multiple. We have the multiples of the business. Multiple for the business is EV to EBITDA is 10.2. So once we know this, we can use this to tease out the EV. EV then becomes 10.2 multiplied by 22 million. This gives us 22.4, something like that. 22 times 10.2. This is 224.4 million. That is the enterprise value of the whole firm. Then they're asking for the market value of equity. And we know from our formula sheet that market enterprise value is market value of equity plus the market value of debt minus cash. The thinking is use your cash to extinguish the cash on your balance sheet to extinguish your debt to get the market value. So we know this market value of debt as 56 million. We know the cash is 1.5. We don't know this, and we know this also. Just want to take market value of equity as subject of the formula and take EV, subtract the market value of debt, then add back the cash, and we'll get to 169. Damlela, are we fine with this? Okay, yeah, great. Let's move on quickly, man. It's almost time. Okay. We saw one particular question before. Okay, 33. Can we try 33? These are the theory questions for us. They're just quick answers. Quick answers. Disadvantage of EV method. Which information is difficult to obtain? Operating income. No. If I have the financial statement, if I have the income statement, I will get great. If I have the financial statement, I will get the operating income very fast. Yes. Market value of debt, because some of the companies don't have that debt trading. So if it's a bilateral debt with some banks, it's not trading, right? I cannot get the market value. If right? Even if I have some bond that they are private bonds, I cannot get the market value at the instant of the valuation. So it's a very important thing to us to note. We are running out of time. Okay, this is almost the last question. Let's do 36 and wrap up the class. Which equity valuation model is more preferable when one is comparing similar components, right? Similar components. Similar components. So is it for this? The first thing is there's this law of one price. Law of one price says similar assets should trade for similar amount, right? And that's the thinking around this multiplier model. So if I have similar companies, Coca-Cola and Pepsi, guys, these two company public should trade at the same thing. Hey, but there are a lot of we just say brand or the good way that Coca-Cola has garnered over the time. But law of one price says similar companies should trade at similar prices. If you use the present value model, right, it can be more tedious in terms of your cash flows and the rest. If you use asset based, might be, but you can get to the answer very fast with your multiplier model. It's most likely preferable when comparing similar components. Similar components, I'll use the market. Because if you use this present value, right, part of the present value is your cost of equity. Cost of equity we adjust for the capital structure, when you want to do the CAPM thing. So your A should be the answer on this side for question 36, multiplier model for similar components. All right, Yemi, I think I'm done. Thank you so much, everyone.
Thank you very much, Biola. Thank you for your delivery. Well received, well appreciated. We are in for the last module of the day, which is derivatives by Fola. Fola, are you in?
Thanks, Yemi. Hi, everyone. Hope you're having a good Saturday. Just a second. I want to try and share my screen. Uh, Can someone let me know if you can see what I'm sharing?
Yes, we can see your screen.
Thank you. So this is the overview of derivatives. This is the universe of derivatives. Two major categories of derivatives. You have the forward commitments and contingent claims. Forward commitments because both parties have a commitment to do something at the end of the contract. Contingent claims meaning that you get claimed to some sort of compensation or funding or money if certain things go your way. So it's like a right. And the major types of forward commitments, I'm sure you've all read this. Forward contracts, futures contracts, and swaps. Contingent claims, you have options and credit derivatives. I won't dwell on this. I just want us to go straight to questions because I feel that's more important than you can always revise this later on. So I'm going to go to some questions I came across and we'll spend the next hour working on them together, if that's okay with you guys. So let me see how I can share my screen again. Share screen, stop sharing. Share screen. Where's this? There you are. Okay. Can you guys see this screen that has a question here? Please confirm that you
Yes,
can
we
see the
can.
screen. Thanks. Okay, so the first question, it's about marking to markets and margins. Um, the CFA guys can be quite tricky in their testing. meaning sometimes they just go into certain places and pick questions that are not obvious, and they would, overlook questions that you would be expecting. So it's good to have an idea the kind of questions that they might ask. So the first one is on margins. Now, this person sells 4,000 equity index futures, 2 to 4 a contract. Now, as we all know, as part of the requirements of a futures contract, you have to put up an initial margin, and there's also something called a maintenance margin. And when the value in the margin falls below the maintenance margin, what happens? You have to bring back that amount. You have to fund the margin back to the maintenance margin. So let me see. Hold on 1 sec. Okay. Okay, good. Now, this person, sorry, hold on. Let's get rid of this. Okay. Okay. So now, but in this question, that's why we need to read the questions. In this question, she is required to provide an initial margin of 20 euros and meet margin calls when her account falls below the maintenance margin, which is usually the case for derivative contracts. But in the event of a margin call, the exchange requires that an additional margin to be contributed up to the maintenance margin level. What does this mean? Normally, when you read the curriculum, they tell you that when there is a margin call, you need to contribute an amount that will take you back to the initial margin level, which would have been, in this case, this 20 euros. But now this question is not saying that. This question is saying, no, we don't want that. We want you to contribute the margin back to 12 euros per contract. So read the questions. Now, the price of the contract over the first, second, and third day is this. What are they asking us? That's another thing. What is the question asking? What is the balance on O'Farrell's margin account on day 3? So let's look at this. On day 1, the price falls, or the price goes up to 234. Remember, she's short. She's the seller of the contract, and she wants the price to go down because that's when she gains. But in this case, the price goes against her favor. So what happens? The price goes to 234, and she loses 234 minus 224. So she loses $10. So now on day 1, her account has minus 10. How much does she have to contribute? Because now her margin is now, remember, her margin is $20. So her margin now becomes 20 minus 10. So how much does she need to contribute? Because she's going to get a margin call. Remember, now her margin is now below this $12. Let me see, is it the chart we are using or the Q&A? Let me see. Okay, the chart. So how much does she have to contribute? 2. Thanks, Uritiola. 2. Someone said 10. No, it's not 10. 2. So now she brings back plus 2. Her margin goes back to 12. We're all good. Margin goes back to normal. Second day, day 2. What happens? The price goes up against her favor as well. Now, what do? You take your 248, which is this on day 2. You subtract your 234 from it. Her margin is minus 14. Now, or the amount that goes out of her account is 14. So she has 12. So you have plus 12. Now you have minus 2. Please, anybody, how much does she have to bring back to contribute back after the margin call? 14. Thank you. Why is it? Someone is asking why is it 2? Why is it 2 is because her, and this was day 1, yeah? So for day 1, the margin fell below 12. The margin became 10 because they took out. So what happens? Oh, I think I made a mistake actually, because sorry about that. So on day 1, I think why is my brain jamming? Sorry, 1 second. 234 minus 2, so you take out 10. Now your margin, sorry about that, guys. Sorry about that, guys. I apologize. So sorry, what's the time? Okay. Let me quickly do it again. And thanks for the observation. I apologize. So what happens?
Yeah, I thought you
She
said we are going back to the maintenance margin level, not the initial margin level.
Yes, we're going back to the maintenance level, but hold on, let me just think about it. You have 234 minus 224, you take out 10. Now, you now take your 10, you now take your 12, which is your initial margin was 20 minus 10, which is 10. Now, guys, please, I'm sorry for confusing you. I was correct in the first place. Please, sometimes I could be that silly. Sorry about that. So on the first day, you had +2. Sorry, but I mistook the margin for 12 instead of 20. So she had 20 here. You took out 10 from the margin. Now you have 10, but now it has to go back. You have to bring back only $2 to bring the contract back to 12. I hope I haven't confused anybody. I'm sorry if I confused you. I was correct in the first place. On the first day, you bring back $2 after the margin call, and then your margin becomes 12. So for the person that was asking why is it 2, it is because the initial margin was 20. You removed 10 because of the price movement against you. Removed 10 from the initial margin, and now you had 10. Now they said if your margin falls below 12 euros, what happens? You need to contribute an amount back to this 12 euros. Now, the amount you have to contribute is 2. Now, the second day is this. You take out your 234 from 248. Now you have 14 minus 14. What happens? You bring back 14. So 14 is your contribution back so that your margin will go back to 12. Remember, the question is asking that our margin level goes back to the maintenance margin level. So at the end of the day, our maintenance margin level should always end up at 12. So that's day number 2. Day number 3, what happens? The price goes in our favor. What happens? You have 248 minus 230. What do you have? You have 18. So she has $18 on day 3. What happens? That $18 gets added to her margin, which is 12. So you have, because it is in her favor. So what happens? You have your 12 plus 18. Her margin is $30 per contract on the first day. And now what are they asking? They're asking for the balance on Ofirio's margin account, which is 30 multiplied by how many contracts? 4,000 contracts, which is 120K, which is here. Let me see if there are, how do I get this thing in? Okay, let me see if there are questions. 14. Okay, thank you. So let's go to the next question. And for the sake of time, I spent 10 minutes on a question. I didn't want to do that. For the sake of time, I might not be able to take your questions. Sorry about that. Let me go to, let me just erase all this first. How do you erase? do I take everything out? I suck at using Zoom. Okay. The next question. Okay, so this is not a calculation question. So who can tell me 101? Which of the following is least correct? A credit default swap is what? What do we think the answer is? Let me check the chat box. Someone said C, someone said B, B, C. Remember, the question is asking which of the following statements is least correct. So C is least correct. Remember, we didn't say, but we saw it in the outline or the diagram I showed you. A credit default swap is a contingent claim, but they're asking which one is least correct. So a credit default swap is not a forward commitment. Next question is, hold on. Okay. Right. Which of the following is least likely to be the reason for, sorry, hold on. Which of the following is least likely to be the reason for an arbitrage opportunity to remain exploited? So why would arbitrage not be exploited? First option, this. Second, what do we think the answer is? Let's see here. C, D, A. So 102. C, A. Okay, the answer is C. Why is it C? There is nothing like ethical objections when you are talking about mispricings. In fact, arbitrage or taking advantage of an arbitrage opportunity has nothing to do with ethicals or ethics, and that's because the market should be based on equilibrium. There should not be mispricings in the market. Also, significant transaction costs, difficulty in entering short positions, all those things would make you not exploit an arbitrage opportunity because they would erode on the profit that you could make. But ethical objections is certainly not the reason why. So C is the answer. Remember, least likely. Always remember that. Remember what they're asking. Now, 103. You have this person takes a 9 months equity forward contract with a forward price of this. After 4 months, share price increased to this. Risk-free is 1.4. What's the value of the forward contract? So now let's look at this. So you have sorry, I might not get the exact, I can't remember how CFA uses their annotations or their symbols anymore. So if this is different from what CFA puts there, I apologize. I've not really gone back to the curriculum in a while. So you have the value of the contract is equal to what you have. You have if it's a long position, you have your ST minus the present value. Is it the present value of the forward price? Discount it by, and then how many months? So this is T, which is the full contract minus where you are right now. I hope you can see my writing. Sorry, my writing is rubbish. Anyway, so now you have your price, which is 2087.54 minus your 1684.20. Discount it. So you discount it, don't forget. 1.0144. And then root of or sorry, raised to power 9 minus 4. Remember, we are in month 4. We are looking at the value of the derivative after 4 months. The derivative expires 9 months' time. So we take our 9 minus 5 divided by 12. So I don't know if anyone can help me with this calculation. If someone can quickly help me do this, I would appreciate it. Where is the... Can anyone help with the calculation? Oh, am I still live? I think. I'm not sure if I'm still live. Okay, thanks. I don't know what happened. For a while, I felt like I was in the dark there. Um, so 1676, really? 411, 411.27. Let me quickly do it. So we have 168 equals to... Where is my... Okay, so the closest answer, the answer I got is closest to this. This is what I got. I'm not sure if it's... Yeah, so B should be the answer. It can't be A because obviously. But it should be B. It looks like B. Anyway, let me see if there's anyone on the chat. Okay, B. Thanks, JJ. So now let's look at the third question. Sorry, the fourth question. So you have this company has a 40 million 3-year debt. Now it pays a fixed rate of interest. So this is now we are fine here. Okay, let's not get too confused. At this point, you just have a company that has a 40 million debt. Normal, you have a loan, it's a 3-year debt. You pay a fixed rate of interest every year of 7.6% per annum. However, this company has sat down and said, I think rates are going to come down significantly over the coming few years. So what does the company do? The company enters into a swap contract with a fixed leg of 4% and floating leg of 90-day LIBOR plus 1.8. The notional value of the swap contract is 40 million, which is similar to the 40 million debt that this company has. And it is based on a 360-day year. Now, if LIBOR on day 360 is 1.3%, which of the following statements is, again, least correct? Now, let's think about this. They are saying that this company expects rates to come down and enters into a swap contract. If you expect rates to come down, remember, the person that benefits at the end of the swap or during a swap is the one that receives more. So now, if this guy expects rates to come down, it means that he would be on the fixed part of the contract, meaning that he would want to be receiving 4%. He will want to be receiving 4% and paying whatever LIBOR is because he expects LIBOR to fall. Now, what happens? Now, what happens is that he has so the net fixed rate payment for this person is, because he's receiving 4%, he's going to have 4% minus, remember, they said LIBOR was, so they're asking which of the following statements is least correct. But let's even look at the value of the swap. They're saying that the floating leg of the swap is LIBOR plus 1.8, and they told us that on day 360, the LIBOR is 1.3%. So you have 1.3 plus 1.8, which is the one that they mentioned here, plus 1.8%. Okay, so far so good. You then say multiplied by 90. It's a 360-day convention. 90 divided by 360. Okay. So when you calculate this, I don't know if you can see what I wrote here. Let me erase this one. So if anyone can help us calculate this, that would be great. Yes, it says 90-day LIBOR. That's why we are applying this 90 over 360. Okay? They are asking us what they're not asking us, but they're saying that if LIBOR on day 360 is 1.3%, okay? Someone said 0.225. Okay, so we multiply that amount by 40 million. So 0.225 times 40 million. What do we get? Let me quickly calculate this. Okay. For 1.3 plus 1.8, 4 minus this, 360 times 40 million. So we should have 90,000. So the net fixed rate should be 90,000. Okay? Sorry. Yeah. Now, what is the question asking? The question is asking us, based on this information, the forward contract to Takada is closest to, sorry, I looked at another question. The 90-day, which of the following statements is least correct? The 90-day LIBOR rate on day 360 corresponds with a swap payment of 90K, 90, okay, cool. The first is 690. A is not correct. And the reason why A is not correct is that the amount that would the swap payment is not going to be 690. The swap payment is going to be 90K because this guy is going to receive 90K because the interest rates went in his favor. The second one is a swap payment made on day 450. No, he's not going to make a swap payment on day 450. He's going to receive 90,000 because the swap is in the bank's favor. The third one is with a swap payment to company XY. So company XYZ will receive this amount. And please, if this is confusing for you, I wouldn't worry too much about it because I don't think swaps are really testable. Like telling you to calculate swaps in level 1 is something they usually do. I think it's when you get to level 2 that it is required for you to know it in deep details. But here, I think they went through in the curriculum for level 1, they just went through the foundations of a swap. So just understand the foundations, understand how swaps works. If you don't understand this question, just understand the basics of swaps, and I think you'll be fine. But I think this question is just really not really asking for an answer, but asking of how this payments would work. So yeah, Let me see if there's any chance here. Okay. How do I erase? Okay, let's look at the next question. An investor is considering purchasing 1-year calls in Dalanium, which is currently trading at 566.2 per Oz. The price of Dalanium will be either up. So this is binomial. I hope you guys have read the binomial valuation method. So the price could either be up 20% or down 90%. So we have to get our U and our up and our down factor. If the risk-free rate is this, the value of the call option is what? Hold on. Okay, let me see if there's any. What was the correct FR for which question? Do you mean 104? 104 was C. The answer to this, yeah, okay. You're welcome. So now let's look at the binomial valuation. Now, for the binomial valuation, you have two factors. You have a U factor and you have a D factor. In this case, the U factor is 20%, which is 1.2. 1.2. Why is it 1.2? You just say 120 over, I mean, let me not, I don't want to confuse you guys, but because it goes up by 20%. Now, what is the down factor? The down factor is 0.9. Okay? Because they are saying you either go up by 20 or down by 10. Now, what happens? The only available call option and has a strike price of 600. So, what is the value? So, what is the price when it goes up by 20%? You have 600 multiplied by 1.2. That's equal to 679.44. Our price when if it goes down, so this is plus, this is minus 600 times 0.9. 0.9. Now, what do you have? You have 509.58. So these are the prices up and prices down. Now, for the call option, remember what the call option is. The value of a call is equal to maximum of 0 ST minus X. In this case, you have for C plus, you have for C plus, you have our maximum 679.44 minus 600 and 0. So the maximum of this, which should be equal to 79.44. C minus maximum of 509.58 minus 600, 0. Now, this is going to give you a negative figure, so this will become 0. Now, we know what our C plus is, we know what our C minus is. What do we have to do now? We have to calculate something called the risk-neutral probability. I need to do some erasing. So slow to erase. Jeez. Okay. So our risk-neutral probability is equal to 1 minus, and the formulas are in the curriculum, 1 minus R minus D all over U minus D. We know what the U factor, we know what the D factor is, we know what the risk-free rate is. We just plug in the numbers. 1 minus, what's the risk-free rate? 0.032 minus D factor, which is 0.9, divided by 1.2 minus 0.9. So okay, so in this case, you should have 0.44. We have our risk neutral probability. We have our C, the value of our calls. Now, the final thing we now have to do is to use that expected value formula, which is I'm not sure which is hold on. Let me erase some things. So you use your expected value formula, which is the value of the call equal to risk neutral probability times C plus, I hope I'm correct here, plus, yes,
Good evening,
sorry,
sir.
can I?
Please, can you check the chat box? I think I didn't really get your calculation. When you said 600 times 1.2 will give you 600 and something. But my own calculation, it gave me 720. And 600 times 0.9 gave me 540. So I
Okay,
dropped that. It wasn't
okay,
matching
okay,
with what
okay,
I
hold on, let
calculated.
me do
I
it
didn't
again.
want to look at it. Sorry, thank you,
Sorry,
sir.
hold on. No worries, no worries. So you had 600 times 1.2. Hold on. Oh, God, that's come again. Okay, so it wasn't so the mistake I made was so silly of me. So instead of 600 times 1.2, it should have been hold on. It should have been 566.2 times 1.2. This would have been the S plus S minus. So I was calculating it with 566, but I was writing 600, so I apologize for that. Nothing really changes except this 562. So if you calculate this now, I don't know who asked that question. If you calculate this now, you should get, let me calculate it. You should get 679.44. Can you
Yes,
confirm
that's
if
what
that's
I
what you got?
got.
Sorry?
Yes, that's what I got
Okay.
now. That's what I
I- I'm
got
s- uh,
now. Thank
okay.
you.
I'm sorry for the confusion. So the second one is the down factor is 509.58. So I hope we all understand what I'm doing. We are looking at the value of the value or the price of palladium, which is 566. We have to calculate the price when it goes up by 20 and when it comes down by 10%, and which is why we have our S plus and our S minus. Now, this S plus and S minus is what we would use to calculate the value of the call options in certain scenarios. So in the first one is the call option sorry, the price at the time when the price goes up to this amount, what will be the call option? And we established that the value of the call option in that case, using the approach that I talked about, is 679.44 minus the strike price. Remember the value of the option, which will be 79.44. The second one is the second for C minus, because our 509 is lower than the strike price, the value of the call is 0. So now we have the value of the C plus and we have the value of the C minus. Then we have to calculate this risk neutral probability so that we would use it to calculate the final value of the call, and which is what I'm doing here. Oops, it's okay. And this is what I'm doing here. So this is 1 minus the risk neutral probability times C minus. So now what do we have? We have our risk neutral probability of 0.44 multiplied by 79.44 plus 1 minus 0.44 multiplied by 0. Yes, Kelechi, I apologize. The strike price is 600. Let me see. Let me see if there are other comments. How did you get 679.44? I'm not clear. Okay. Okay. So you have 0 here. We calculate this. This should be. Oh yeah, we have to discount it as well. Sorry. We have to discount it as well by the risk-free rate. So this will be 1.032. Remember, it's a 1-year contract. So now what do we get? We should be getting 33.87, which is B. Thank you. How do we get 0.44? We got 0.44 using this formula, which is the risk neutral probability. Okay? Okay. Let's move on. So for this binomial valuation, I think it's more extensive in level 2. They discussed it briefly in level 1, but I'm not sure if it is testable. But for this binomial valuation, you just have to remember the formulas. So you have to remember the U factor, you have to remember the D factor, you have to remember the value of the calls for C plus and C minus. You use the U and D factors to create the prices. So you use it for the S plus, S minus. You have to know the formula for the risk neutral probability, and then you have to know the value of the call, you know, the formula for the value of the call. Okay. Yes, it's 1 plus R. Did I say 1 minus R? Oh, it's 1 plus R, okay? In the formula, that risk neutral probability formula is, I'm not sure which one you're talking about, but the the formula for the option, so 1 plus R, sorry, and then you discount it. Sorry, 1 minus pi here. This is 1 minus pi all over 1 plus R. Okay, let's go on. Now, okay, I think we're done with this. Let's move on to the next set of questions. Number 98. In comparison to the underlying spot market, derivative markets tend to be what? Let's look at the options and give our answers, please. I think the videos are available on YouTube. C. C. Okay. Offer easier access to leverage and short positions. So C is correct. Derivatives don't entail higher transaction costs compared to spot markets. They are more liquid than spot markets. Number 99, we can do number 99, but I'm not gonna do it because it's not really it's in level 2 that you would apply all these things for 99. That you apply this kind of LIBOR and you go into more details on this. So I'm not gonna go into number 99. Number 100. Let's look at 100. Here, this one. Now, BWC is a fixed rate payer on the plain vanilla swap. Since interest rates commencement, interest rates have fallen considerably. Now remember, there are two rates in the swaps. There is the fixed rate and the floating rate. The floating rate is always based on some sort of market rates, which fluctuates. So if this guy is a fixed rate payer on the swap, so this guy BW pays the fixed rate and receives the swap the floating rate. What are they saying? Interest rates have fallen considerably. Obviously, the interest rates are falling below the fixed rate that this guy is paying. What then happens? He is paying more because interest rates are falling. He's paying more and he's receiving less. What then happens is that in net, he's going to be paying. He's not going to be receiving because he's going to be losing money. Now, what are they saying? Which of this is most accurate? What do we think the answer is here? 100. C. Let's see. The present value of the floating rate payments will be lower than the present value of the fixed rate payments. Correct. The swap will be an asset for BWC. No, the swap will not be an asset for the BWC because BWC is losing money. The swap fixed rate would have fallen. The fixed rate of the swap does not fall. It is constant. It does not change throughout the contract. So C is the answer there. Now the next question is, now this is options. The price of an underlying security is 520. So our S is $520. A put option with an exercise price of 528 has a premium of this. The put option is currently trading. So when we are looking at trading in the money, out of the money, we ignore the premium. We're not looking at whether it's a profit or loss. We're looking at whether it's in the money or out of the money. And for a put, when the exercise price is greater than the stock price or the asset price, underlying asset price, then this is in the money. And when it is lower, when X is lower than ST, it is out of the money. So now what are we saying? We are saying the price of this is 520. The exercise price is 528. So our exercise price, 528, is greater than our 520. So it should be in the money, isn't it? Yeah, it should be in the money. Okay. Um, we have less than 50, we have 15 minutes to go, so let's try and do as many questions as possible. So now let's look at the next question. Number 102. Which of the following statements is most accurate? The lowest value of a European put option is what? So now remember, there is a value of an option and there's the lowest value of an option. The value of an option is our maximum 0 x minus st. The minimum or the lowest value, remember, there's a literature on it in the curriculum. When they say the lowest value, okay, of a European option, you discount something. So this will be max, you discount the exercise price, x minus 1 plus r. So it's the present value of the exercise price minus st. Please, let's remember this. So the minimum value or the lowest value of a European put option is number one, A, the premium or the present value of the exercise price less the premium. No. 0 and the underlying price plus the present value of the exercise price. No. C, 0 and the present value of the exercise price less, so the present value of the exercise price less the underlying price. So 102 is C. Now, the next question, 103. Early exercise of an American option before dividend is most likely warranted. Let me see if we can answer this. So, what are your answers for 103? Someone says C. For 103, what's 103? Anybody? I hope I'm not blocking. So let's think about it. Okay, someone says 3. Sorry, C. Let's think about it. You have an American option. Now, what happens before a dividend? If you exercise an American option immediately before dividend, if it is a call option, for instance, you buy. So when you exercise a call, you buy the stock. You now own the stock, meaning that you get dividends. So what are they asking? They're asking the early exercise of an American option before a dividend will most likely be warranted, yes, for a call option. Why? Because a call option is an option to buy. Now, when you exercise and you buy the stock, you now own the stock, you gain these dividends. Let's look at the other options and criticize the options. B, when carry costs are significant. When carry costs are significant and you own the stock after you exercise it, you are losing more because you are paying a lot of carrying costs. For a put option, well in the money. If it is a put option, remember, a put option is an option to sell. So it means that if you exercise a put option, it means you are selling the stock. You don't own the stock anymore, meaning you would not benefit from a dividend payment. So that's why they said it is most likely warranted for a stock call option. Okay, now let's move on. 10 minutes more. Okay, thanks. So let's quickly look at a few more questions and we'll call it a day, a night. Value of a forward contract at expiration is what? What's the answer? 89. Which one do you want me to explain, FR? The previous one I did. Okay, let me just quickly explain it. I'll use the next 1 minute to explain it. So what happens is you have an American option. And remember, an American option can be exercised anytime. It's not like a European option that you have to wait till maturity or till expiration before you exercise. Now, what they are saying is this. They are saying sometimes people exercise American options before dividends. And they are saying what would be the most likely reason? So before dividend payment on the underlying stock. So we're saying that what would be the most likely reason that I would exercise an American option? Why would I exercise an American option before dividend payment? So they said they gave us different scenarios. So let's look at it. For a call option, you own a call. You own the call, and call gives you the right to buy a stock. So what happens before the dividend? What do? You buy the stock. Guess what? The stock is transferred. Ownership of the stock is transferred to you. You now own the stock, meaning when there is a dividend, you get the dividend. And that's why we said A is the answer. We said B, when you exercise an option, so for instance, if it is a call, hmm, if the before dividend, if it's a call and you exercise an option and you own the stock, and the carry costs are significant, meaning that you pay a lot of money just to hold the stock, which is unlikely in this case. The third one is for a put option when the put option is in the money. Remember, for a put gives you the option to sell. Now, when you sell the stock before a dividend, what happens? You sell the stock, you receive cash. But guess what? You don't own the stock anymore. You don't own the stock anymore. So what happens? You lose out on this dividend. So we are saying that the reason why somebody would likely exercise before dividend would be because it is a stock call option and this person would benefit from the dividends that the underlying stock pays because you are owning the stock now. Okay. How many minutes? I think I have less than 5 minutes more. I'll just look at one more question and maybe two more questions, depending on the. Okay. I really want to do this 90, but let's quickly look at 89. 89 should be a no-brainer. So 89 should be B, is it? Or C? The value of okay, so 89 should be B, isn't it? Minus the forward price, because we are saying what is the value of a forward contract at expiration. Now, the next one is number 90. I really want us to do this. Number 90. Hold on. Okay, so let's quickly look at number 90. They are saying a put option is selling for $6. The premium for the put is here is $6. Now, the exercise price is 72 and the price on the underlying is 77. Maximum profit to the buyer and break-even price at underlying expiration of underlying at expiration is what? So let's look at this. The maximum profit that a buyer of a put can make is this. So let's look at it. We said the price of the underlying is 77. If the put goes in the money, what happens? You have your you sell the underlying. So if the value of the option of the underlying goes below 72, what happens? You sell the underlying for 72. Okay? You sell it for 70, you receive this amount. Now, the maximum you can ever receive is 72 minus S, depending on where the price goes to. What is the least price that a stock can ever get to? What is the lowest price that the stock can ever get to? Can anyone quickly answer? So if a stock is falling in the market, what's the lowest price that it can ever get to? Okay, I'll answer that myself. The lowest price that a stock can ever get to is, I think someone has said something, 0. So the price can go to 0. So what happens? You can gain as much, the maximum profit the maximum amount profit you can ever make from this put strategy is 72 minus 0. That's the price going to the floor, minus the amount that we used to buy the option, which is 6. We paid $6 for this option. So the maximum amount here is 72 minus 6, which is 66. So this 66, break-even price. So we are looking for the price that at the end of the day, our profit will be 0. So we have our 72 minus 6 minus S. So we're looking for that price, yeah, that will give us 0 when we try to calculate our profit. So this will be 72 minus 6. So this is 72 minus 6 is equal to S. S is equal to 66. So break-even price is 66. So our answer here is A. Our answer here is A. Okay, I hope you understand the logic that I tried to explain. We're looking for the maximum profit to the buyer. The maximum profit is when the price falls to 0, because we can then exercise and make profit. And then we have to take out the price we used to pay the premium. The break-even is that price that would give us 0. So what I just did was I just put S and looked for S, the value that it would take for us to only break even. Okay? Now, let's quickly look at number 91. Derivative price is least likely depends on what? Number 91 should be B. The reason why it is B is because derivatives assume risk neutrality. So we don't look at risk aversion. And that's why we use our risk-free rate to discount in a lot of our formulas in derivatives. In your equities in corporate finance, you use risk aversion, meaning your risk-free rate plus a premium. Here, we don't apply that premium here to our risk-free rate. Okay, I think we are already at the end of my time, so I'm gonna hand over back to the moderators, and I want to wish all of you good luck, best of luck in your exams. Please don't forget, as much as reading is important, solving as much questions as you can is very, very important. And I don't mean it just in derivatives, in every area of your CFA. Thank you.
Thank you so very much, Fola, for that very quintessential delivery on derivatives. It's a wrap, ladies and gentlemen, on day one. But before we close the curtain on today's session, I'd like to use this opportunity to thank our sponsors. That's First Quartile. First Quartile is a tuition provider based out of Abuja. And I also like to thank New Frontiers Learning. They are also a tuition center based out of Lagos. In addition to that, I'll be remiss in my duty if I don't thank our faculty, members of our faculty in the order in which they presented. That's Muhammad Buba for alternative investment, Bukola Akerele for portfolio management and wealth planning, Hassana Umar for economics, Abiola Ahmed for equity investment, and Fola Abimbola that just finished derivatives. Tomorrow, we will be expecting to have sessions on financial statement analysis, corporate issuers, fixed income, ethics, and quantitative analysis. I will also be remiss in my duty if I did not say a very big thank you to members of the executive office that have rendered support to our faculty and for this platform and for this bootcamp. And Sonia Dawaga. Thank you. We look forward to keep your journey towards ending your charter. Thank you very much, everyone. Have a great day. Bye. Until tomorrow.
By what time?